Welcome to the Pre-Approval Podcast. I am here with Angelo Christian. Hello, how are you?
How are you?
I'm doing fantastic. Thanks for joining us. I had a little intro on, your bio, but I don't think that I could do it justice. Do you mind giving me the quick rundown of all the different things that you can do? Because I don't think I could articulate it as well as you could.
Yeah, I like that. I like actually introducing myself. That's good. I like that. Yeah. So everybody, I'm Angelo Christian. Thank you so much for watching our show. I've been in the mortgage industry for over 20 years, helping tens of thousands of Americans all over the country, funding billions of dollars in loans. Our whole mantra, and we've been featured in Bloomberg, CNN, Good Morning America, Business Insider. And really the biggest thing with us on how we're different is we're extremely passionate on trying to figure out how to help clients. And that's the biggest difference with us is, like I was telling a customer today, whereas most lenders, if you don't qualify, you're just denied. They don't show you how to get approved, how to get the loan, how to make it happen, right? So with our company, we have two different divisions, two silos. We have private money lending, where we focus on non-QM. And then we have our banking division where we do like jumbo, conventional, FHA. So we can really cover all the bases and try to help every customer that comes through our door. So our whole mantra, how we're different, is trying to figure out how to help people to get funded. It's a huge, massive statistic. Millions of people get denied from banks every single year. Those people are still hardworking. They still pay their rent. They deserve to own a home. Why aren't they getting funding? Why aren't people taking care of them? And so that's the niche that I focus on. Like I was telling you before we got on the call, we just got done helping a family move from California to Texas. They had some issues, some spotty credit. They got hurt from COVID. They were self-employed. They had cash reserves though, and the bank denied them for their loan. They applied with 10 different lenders. They're getting a brand new home built in Dallas, and they couldn't get a mortgage. They're supposed to close in February. And they just called me. They saw my YouTube video and said, "Hey, Angelo, can you help me?" I said, "Yes, I can help you. If you can do X, Y, and Z, I can get this loan funded for you." Got the loan approved, closed it in 16 days.
That is fantastic.
And that's how we're different. We're going to try and figure out, now we're not a nonprofit company. We're not a March of Dimes. You have to be able to pay your mortgage. But if you meet some of the requirements that we have that are pretty basic, we can help you. We can talk about those requirements on the show today. But that's really how we're different. We cater to the person that, maybe you're self-employed, you have a great business, but maybe you write off all your income on your taxes. Maybe you're a large real estate investor and you own a bunch of rental properties, and your bank doesn't want to deal with you because you have too many real estate assets, or so. And we deal with large clients too. We're a Fannie Mae and Freddie Mac multifamily lender. So if you're trying to buy a massive apartment complex, we can help you to get that funded. We do commercial lending, we do residential lending. We specialize in jumbo loans, HELOCs, private mortgages, no documentation loans. So where most lenders just do one thing, like your bank, Wells Fargo, just as like a conventional loan, we try to cover all the products. And I've been a student in the mortgage industry for over 20 years. I'm a published author. I've written 3 books about mortgage and real estate. And so it's all I know. So when you talk to my team, you're getting the best of the best, the cream of the crop, that whenever we hear your situation, we figure out how to structure your loan with a master skill set to put you on the best loan, to get you the lowest interest rate, to get you the lowest amount of fees, whatever we can do to optimize your situation for the short term and the long term to put you in the best financial position.
That is a great intro. And one of the strongest reasons why you were one of the first interviews, having reached out, knowing what your credentials are, looking at what you've done in the industry and supporting the mission of helping people become a homeowner when they think it's impossible, is the entire goal of this show. Awesome. And so that is a great mission that you're doing, getting to, get someone into a home when they don't think that they can. So as we look to break that down a little bit, you covered a lot of the great areas. When someone says there's so many options out there, there's so many different lenders, I don't know the difference between a jumbo and a non-QM. Like, I don't know what these terms are. I just want a bank loan. How do you normally approach that situation, or get in touch with someone that's really maybe confused? They went to the traditional bank, it said no. And then they're, looking at the next step, and they're maybe either fearing getting rejected again, or just think that you're just another bank. Maybe you can clarify a little bit differently on that, and what in the world is a non-QM.
Yeah. So these are good questions. So the first thing is that what's really important, Adam, is that when you're talking to someone like myself, for example, a lot of lenders or realtors, they talk too much. And what I try to do is not talk as much and let my client talk and really qualify them to make sure that I understand what their needs are, what they're trying to do. And so we really qualify the prospect, is what we call it in our industry, to make sure that we understand, what can they do? What are they eligible for? What's their situation? What kind of money do they have? What kind of money do they make? What's their credit situation? So we go very deep into the understanding of the client. And then very much like a doctor, when you go and see your doctor, he's going to ask you a bunch of questions, run a bunch of tests on you to come up with a diagnosis and then a treatment plan. That's very analogous to what we do, right? So we try to figure out, okay, this is their situation. And then from there, we diagnose the optimal loan program. Some people, they want a jumbo loan, but they don't qualify for a jumbo loan. They qualify for non-QM. And some people want, I've had people that ask for private mortgages and they don't need a private mortgage. They can get a bank loan. It doesn't make any sense. So we have to go through that exercise to determine what's going to be the best loan program for them. And from there, we can apply, what product's going to actually work the best. But so that answers that question. Then the question on what's a non-QM loan. So a non-QM loan, non-QM stands for non-qualified mortgage. So after the subprime crash of 2008, Dodd-Frank, which were two politicians, they really stepped in. They helped to revamp the mortgage industry, and everyone has a different opinion if they did a good job or not. But basically, these two politicians passed a lot of laws, and there's now a difference between a qualified mortgage and then a non-qualified mortgage. And basically, a non-qualified mortgage is a mortgage that isn't regulated under the same restrictions as RESPA and is exempt from some of the qualifications as a conventional loan, namely with debt to income ratio, income qualification, real estate owned properties, the amount of properties that you own. I'll go into some of the examples here in a minute, but essentially it's exempt from some of the requirements of a conventional loan and has a whole separate field now. And what happened after the crash is a lot of lenders went out of business, but also emerged a whole new marketplace, right, where non-QM, non-qualified mortgage could flourish. And a lot of lenders have come into that space. And what I was telling you earlier is that, and this was in Bloomberg, is their published information, not my talking, but the non-QM space right now is expected to explode in the next 3 years and grow by 400%. Because what's happened is more and more customers are not being able to get approved for a conventional mortgage. So they have to go to alternative markets to get the funding. And now you're seeing, companies that are, now going public that are worth multi-billion dollars. Angelo is one of them. Angelo is a massive lender in this space.
We just had them on earlier today. So it's fantastic.
Okay.
Yep.
Okay. Yeah. And we do a lot of business with them. And so, but the whole idea behind it is, let's say that, for example, non-qualified mortgage yourself. I'll give a typical example. You're a business owner and you can't document your income with your tax returns. Let's say that, you own a church, you're an entertainer, you're a dancer, you're an actor, you're, self-employed entrepreneur. And maybe after all your deductions, you don't qualify for a 40% debt ratio at your bank. You have the money for the down payment, but because of the deductions on your taxes, you're not eligible for a conventional loan. Well, does that mean that you rent for the rest of your life? I mean, no, it doesn't mean that at all. But if your banker's telling you don't get the loan and you don't know about Angelo Christian or this outlet, then you're stuck there renting for the rest of your life. So non-QM is helping millions and millions of self-employed people and also real estate investors to get the funding that they need and deserve with great terms. These are not hard money loans. A lot of people think that non-QM is hard money, and it's not the same thing. Hard money is a completely different product than non-QM. Non-QM, they're 30-year fixed mortgages. They can even do interest-only products, if the investor wants to pay interest only. So that's the definition of non-QM, and it really services people that are, there's a few different spaces inside of non-QM. You have the self-employed, like we talked about. Then there's something called non-prime. Non-prime is not like subprime. It's different than subprime in the fact that they will go down to lower credit scores like 550, 580, 600, but there's a large equity spread that's required that's in the loan. So in other words, I'll give you an example. We had a client that was purchasing. This was actually in Washington, D.C. As an attorney. And they wanted to purchase a $1.6 million condo, right? That's a jumbo loan. Jumbo loans, you got to put 20, 25% down. But they only had 15% down, right? They said, Angelo, I can't do 20% down. I don't have the extra money. I don't have that. My bank denied me. What can you do for me? I said, well, we can offer you a non-QM, loan, and you can put 15% down. Your interest rate is going to be a little bit higher, but that'll at least get you into the property, and then you can refinance to your bank in 6 months or whatever, But because there's no way to get you funded if you don't have 20% down right now. We could look at a non-QM loan if you put 15% down, and then you can use this as a bridge. I like to use non-QM loans as a bridge to get you to where you want to go. And then you can refinance later once you have equity built up, once you have more reserves, once your credit's where it needs to be, and then you can go to a perm loan. So, in that example, for people that, then they had great credit, but in that example, because of the size of the loan they're able to get, their property with only 15% down. But it also comes into play. Let's say that the client doesn't have the best of credit, but he wants to refinance and pay off all of his debt. Well, that's where non-QM can come into play and help. I've helped thousands of customers that are in a heavy debt situation, refinance, restructure, pay off all their debt. They had a 550 credit score. But by the time we paid off all their debt, their credit score shot up to 700, and they were debt free. They got out of debt. Right. And those loans are only made to like 70% loan to value. So the difference is between non-QM and subprime. Subprime, you're getting no income verification at 100% loan to value. Non-QM doesn't work like that. You have to document income. And there's a large equity spread, normally of, 70, 75, maybe 80%. So the lender is covering their risks. And like I was telling you before, and during this whole COVID thing, if you look at the default rates for mortgages, there's a higher default rate on FHA mortgages than there was for non-QM.
That is very surprising, because most people would think the other way around.
Well, you would, but if you think about it, like I said, if you're at 65, 70% LTV, 75% LTV, that guy's not going to let that property go into foreclosure, right? But if you're a first-time buyer, you got zero down grants, you got down payment assistance, you did FHA. Okay, man, I lost my job. I got to let the house go. They're not going to give me they're not going to do a forbearance anymore. They're not going to extend the payments. And that's really what the statistics are showing, right? I mean, I'm not making this stuff up. You can go look up it online. It's all over the place. And so, who
can get a non-QM? I mean, is this available in all 50 states? Is this only available in the big cities? Do people have a false representation of that? And then to that point, where can they get this? And then number two, where do you service?
Yeah. So we lend nationwide. So, and non-QM is available nationwide. We lend in all. The only state that we don't do owner occupied in is Maryland, but in all the other states we lend for non-QM. But we can do investor in Maryland. But yeah, I mean, I don't care if it's Hawaii, Alaska, North Dakota, Texas, Florida. My license. We're lending in all 50 states. So except for Maryland for owner occupied. So yeah, I mean that's perfectly fine. And non-QM is all over the country. Even non-QM. We'll even do smaller towns and smaller cities, even more rural areas. If they have that equity spread there, then we can make those loans. I've done loans in little small towns with 1,000 people and loans in New York City. So, I mean, so it can be anywhere, and it's a really, really awesome product. The other area that it services is not just the self-employed or the lower FICO person. It also services the investor. And if you ever were helping real estate investors, we help a ton of real estate investors, because with conforming loans, you're limited with Fannie and Freddie to 10 properties, 10 mortgages. And with non-QM loans, it's unlimited. I have investors with 300 properties, 200 properties, 50 properties, 30 properties. There's no limit on non-QM. And
is that with their individual name, or does that go then through an LLC if you're doing it that way?
It can be, and that's the other thing too. It can be in their LLC.
Fantastic.
Yeah, it can be in their LLC. We can put the docs of the loan, the title in their LLC. And conforming loans, you can't do that. Yep. So that's another really, really cool thing about non-QM. So, and like I said earlier, for investors, you can do interest only. Investors love to do interest only. So it has a huge market. And we love the market for it. I mean, we love helping people get loans done, getting them closed. Now obviously, like I said, if you can qualify for a bank loan, then by all means go and get it. I'm not knocking that. I mean, we do bank loans too. And I told you earlier, we do jumbo loans. We do we're one of the only lenders in the country that does first lien HELOCs. We do jumbo loans, only 5% down, no PMI. So we have those products too. But the focus for today that we've been talking about is the non-QM space, because it's an awesome space. And we're one of the only lenders in the country that's taken the time to actually learn about it, master it, and then service those customers that actually need it.
That's phenomenal. So what I'm hearing from this is when someone contacts you, whereas, maybe there's lender A through Z, right? Where there's 26 different lenders. And sometimes if you go to the conventional space, you'll get lender A and they can do lender A style information, or you get a broker that can do A, B, C, X, Y, Z because they're brokering 6 of these, but they can't touch ST, L and E. Whereas finding you, not only do you cover the conventional space, but you're doing the non-QM. And then you even brought up something on private mortgages. Can you explain a little bit difference between private mortgages and non-QM, or are they the same thing?
Well, no, they're slightly different. So like a private mortgage, that's going to be, similar to it depends on the file, like what the person's trying to do. Private mortgage in the sense that, first off, it doesn't report to your credit. So it's a private loan. But depending on how we have to structure the loan, it's almost sometimes borderline hard money.
Is it almost like a land contract or a contract for deed?
Well, private mortgage is so usually I would say it's more closer to asset-based lending, where, like, for example, let's say that I'll give you an example. Let's say that the guy's got a home that's worth like $600,000. And he says, look, man, I need to pull $300,000 cash out of this property. I can't verify my income. I got a 500 credit score. Now, where's this guy? Who's going to give this guy a loan? I mean, nobody, on earth is really going to touch that. Not a bank, doesn't have a job, and, it's rental property that he owns. We'll make a private mortgage to this client. It's a customized product. Hey, look, I'll give you 50% loan to value. I'll give you a loan for 300,000 and do it on a 2-year loan to help get you some cash to get on your feet. And so basically, it's not credit driven. It's not really income driven. It's based on the underlying asset. If we like the asset, say, look, we'll make a loan. Usually those loans cap out about 65% loan to value, and they're for people that they either can, like, for example, foreign nationals from other countries. They're trying to buy properties. They're trying to buy real estate. They come over from Canada. They come from, Ecuador, Brazil, whatever, Cuba, and they want to buy a home. Well, they're a citizen of another country and they can't document any income here. So we'll give them a private mortgage. They'll put 35% down. People that have a tax ID and ITIN, tax ID loan, people that are from another country, they don't have a social security card. They can put 20 or 30% down. We'll make a private mortgage to them. It doesn't report on their credit. The lien gets recorded, and we still go through some of the verification process. But the bet is that because this individual is putting this big of a down payment, that loan's not going to go in default. Now, these loans they are higher interest rate loans, so you're not getting a 2% rate. Okay?
So what are we talking here?
So the interest rates, they start at 5%, and depending on the situation, they can go into double digit. Depending on what the case is. Because this money is pooled from investors, and these note holders are not going to do these loans if the underwriting has lax requirements. Then the inverse has to be heavy equity spread, right? If we didn't check that guy's income, then we're capping that thing at 50% loan to value, because that's the only way it would make sense.
Yep.
You can't, because where you're going to get in trouble with lending is if you have a high leverage and a lax due diligence on underwriting, right?
Yep.
So and then those loans perform excellent. You'd be surprised, the guy that owns the lawn mowing company, he'll put 20 or 30% down and make his payments like clockwork.
Yep.
So we love catering those people. So
Yeah, I always thought entrepreneurship and self-employment was hard enough. Why stack the deck against you on the mortgage industry and make it any harder than it is? And so my quick, assertion from this 20-minute discussion, because this is the first time we're having a conversation, is it would appear that if Angelo can't get you into a home, nobody can. Is that fair to say? Or is there anything that you guys don't touch?
Yeah, I mean, no, I do tell people that. Look, I mean, if there is people. Before I came on your show today, I told someone, look, I mean, right now, like, I'll give you an example. He wanted cash. He's going through a divorce, and his attorney's making him liquidate the equity of his home to pay off his ex-wife, and he wanted $300,000 in cash. I said, look, buddy, I can only get you $150. That's the max I can get you, and there's no one else on the planet that's going to be able to get you more than what you want, unless you sell your house. Right. But if you want to stay in your home and refinance based on your situation, this is the max you can get. So, yeah, I do tell people, look, if I can't figure this out, I'm not saying I'm the smartest in this industry. I'm not saying that. I know there's great lenders out there that are really, really good. But I will scour the earth to try and figure it out for you.
So is that where, Fannie and Freddie are more tightly regulated, whereas what you're doing to satisfy investors and, almost from a risk reward perspective, is there still some, regulations that you absolutely can't break versus, how much do you have free range, basically, saying it's almost an open market. If an investor is willing to buy a home for someone at 5%, could they still do that outside of, any regulations?
Well, I mean, yeah, there's always going to be, I mean, so there is regulation. The thing is that, it's because they're not regulated under, RESPA. There are still regulations. There's laws. There's usury laws.
Do you mind breaking down RESPA?
Yeah. So, I mean, RESPA is this Real Estate Settlement Procedures Act. It's an act that was passed by the federal government. And really the idea behind it is because to prevent predatory lending, full transparency, full disclosure to the consumer. And those are going to be more of your conventional loans, your FHA loans that fall under that criteria. And, you have to, disclose all the fees, all the interest. You can't change the terms to your client. You have to, there's very tight tolerances. Like if you disclose, for example, the closing costs are $5,000, you can't come back at the end of the close and say, oh, I'm sorry, I made a mistake. They're now $10,000. You can't do that anymore. So if you told your borrower the closing costs are $5,000, you have a 1/8 tolerance that you can stay within for your interest rate and your closing costs. And if you're wrong, the lender has to cover that deficit. So it was really put into place to prevent things like that from happening, to reduce any type, for example, negative amortization loans, which is big in subprime, where the property loan actually negatively amortized and the balance would increase and people be upside down their property. So RESPA puts into place a lot of the full disclosure on the terms, the conditions, and holds the lender accountable to the consumer, right? And hard money loans, private loans, they really don't fall into that category. There are still laws that protect, business owners, consumers. And so the biggest one's probably going to be, you have laws under usury, like you couldn't charge a customer a 30% interest rate on a mortgage. I mean, there's just laws against that. That's too egregious. And so, but for the most part, it's really customizable to the investor, to the lender on, what they're willing to do. It's not like, for example, on a conventional loan, when you make an application, you have to disclose it within 3 days. That's a law, right? A hard money loan doesn't apply there. I could never disclose anything. I mean, I talked to the guy, nothing happened. I don't want to look at the guy's credit report. I don't have to look at his credit report. I mean, so it gives the lender more autonomy. And it's a multi-billion-dollar marketplace. It's a multi-billion-dollar marketplace. There's huge lenders out there that that's all they dance in, right? So, but that's really the key differences.
When you're talking to a customer and there's all of these different options, it kind of seems like you walk them down the path where they say, hey, I want option, X. And you say, well, wait a second, like, let me listen to your situation. Let's see everything that's going on. Maybe you qualify for, option A or option B or C. And you go through all of the gamut of this is probably best case scenario to worst case scenario of like, yeah, we could give you a private money loan at 12%, but why not take a 5% non-QM if you qualify for it?
Well, yeah, I mean, because of this, I mean, to save face and time, and we ask them the questions and then tell them that's what they're going to do. Because I mean, yeah, because if we ask the person what do they want, that most people they don't. And I'm just being very frank with you. I mean, they don't really know the industry, right? And so they could ask for that, but then we could talk all day about products. So we say, what is it that what are you interested in? What are you trying to do? What's the goal? Is this a short-term thing? Is it a long-term thing? Tell me about your situation. And we go through the credit, the income, the assets, and then we will advise them, hey, look, this is what you can qualify for. This is what you're going to get. So, because I mean, people that are, for example, we have offer investor lines of credit. There's no point to offer that to a first-time buyer millennial. I'll even talk about that right now.
Sure. So as we maybe progress to the next part, I'm really hoping to pick your brain on a lot of the specific rapid fire questions that we go through.
Uh-huh.
So because you are both in the QM and the non-QM space, I'm gonna read off some stuff, and I'm gonna hope that you can either tell me true, false, or kind of, as like, hey, we're close. So if I said that in the QM space, you might get a rate from 2% to 4%. Does that sound about right?
Yeah. Yeah.
If I was saying that your down payment could be as little as 0% down with like a USDA to maybe 20% down, so you don't pay any PMI. Does that sound about right?
Absolutely. Absolutely.
If you're looking at fees, if you're on the QM space, that's, you're not going to see 3 or 4 origination points. You might see one point on that. Is that about right?
Yeah, that's right.
And then no prepayment penalties or anything on the QM side.
That's correct. That's correct. Yeah.
For income requirements, I was talking with an individual earlier today, and they said, well, W-2 is great, or we kind of need to see 2 years of taxes if you're in the QM space. Any other gray area there?
Yeah, I will talk about that for a second, because we are one of the only lenders in the QM space that we can do loans with W-2s only, pay stubs only, tax returns only, or 1 year tax return only. So there's a lot of shades of color right there. So it's not just tax returns. We have a product with just 1 year of tax returns for self-employed. It's called our 1 year self-employed loan. We have programs of just 1 year W-2. We have programs of just pay stubs. So, and we have programs, with the tax returns.
So I think one thing that maybe differentiates you from others that we've interviewed is the 1 year tax return. Do you mind? Is that worth diving into a little bit?
Yeah, it's great. Yeah, we do a ton of them. I mean, so I'll give you an example of. Basically, it is what it is. I mean, it's self-employed, and let's say that 2019 was spotty, but 2020 you had good income, right? Well, normally when you get a mortgage through a bank and you're self-employed, they want 2 years of taxes and they average out the income. And if 2019 was bad, it's going to reduce your qualification of your buying power. So, if 2020 was a much better year, then let's get rid of 2019. Just use the 2020 so you can qualify for what you want. So
awesome. And I'm assuming you can't go 2019 and ignore 2020, depending on the time of year. Like right now, nobody has their 2020, so you could use, 2019, but I'm assuming you can't use a 2018 if you do have a 2019 tax available.
Yeah. So it's your most recent. You're at your most recent. Yeah, that's a good idea. Yeah. But yeah, it's the idea behind it is, I have a client that owns a restaurant in Florida, and his 2018 he just started the business, wasn't that good, and then 2019 he made a ton of money, right? And he wants to buy $500,000 home, put 20% down. And every bank, I don't know why. I mean, they just denied him in Florida. I don't know, just they couldn't figure it out. And, for me, it was, 2-minute call. Hey, get rid of the 2018 tax return, just use the 2019. And it's a no-brainer. So
awesome. What a great solution for that person.
Yeah.
Fantastic. All right. And I have that the service area is anywhere in the United States that you can find a lender that services that area.
Well, we are the lender, and then the only state that we don't do owner occupied in is Maryland.
Yep.
We can do investment properties in Maryland. But nationwide.
On the qualified mortgages and
non-QM.
Sure. So if I just rattled off all of the QM, and I maybe should have qualified that the 2 to 4, the 0 to 20%, the 1% origination, like I'm reading off a row of all the QM. And so then what I'm hoping to do is switch, because you're also an expert in both of these, is switch to non-QM and start talking about interest rate, down payments, potential fees, credit scores. And so you hit on a couple of things that, as we're building what we're calling this, kind of ultimate rate sheet, where it's going to list out all of these different options, realizing there's no way we're going to get everything right and it could change tomorrow. But just to give people a frame of reference on, which bucket that they might fall into. If you were looking at the non-QM, a lot of those I had noted that, maybe starts at 5% and goes up, potentially to double digits. But in that sense, what we were just talking about, what you're saying is there is some non-QM products that could potentially get below that would be more competitive, or would you say that the interest rates on non-QM would be in that, maybe 5 to 10?
So yeah, non-QM, I mean, you could get those starting at 4%.
Okay.
I think that's the floor rate is going to be 4, maybe 3.8, 4%. And then, as high as, you could go, 10%. I think that's a very realistic, to expect that. I mean, depending on the deal. Yeah. And
then non-QM for down payment, is it kind of a 20%, down payment, or 80% loan to value kind of is the acceptable threshold, or what you should expect, kind of the starting point?
No, I mean, you can go right now, as of right now, it's at up to 90% loan to value.
Okay.
10% down. And then, it just goes down from there. 10%. If you have a very high FICO score, like 720 or higher, you can get 10% down. If you have, 650 credit, it's going to definitely be 20% down.
Sure. And so that's where it sounds like you got all these different levers that, as we're going through this, your interest rate depends on potentially your down payment, your credit score, it depends on your income requirements, depends. So all these different levers that we're talking about impact, maybe one another. So it's tough to, and what we're trying to do is not paint you in a box and be like, yeah, it's this, because you're basically saying, well, it depends on the other factors that you're going through with it.
Well, absolutely.
So in general, you can get with the 10% if you got a great credit score. Otherwise, if if it's a little bit lower, 650 or so, that would be, maybe 20% or the 80% loan to value.
That's right.
When you look at fees associated with QM as you relate it to non-QM, for the non-QM fees, is that pretty similar, or would you expect anything different from origination points or prepayment penalties or anything like that?
Yeah. So origination could be anywhere from 1% to 3%. And then, if it's an investment property, they'll definitely most likely have a prepayment penalty. And then you can buy out of that penalty. Usually the penalty will be for 3 years. And if you want to buy out of it, you can, but there's a cost associated with it. It could be anywhere from, 50 to 100 basis points, or you could pay, a point to buy out of the prepay.
Sure.
But if it's owner occupied, there is no prepay if it's owner occupied.
Awesome. And so that's really the benefit there on the owner occupied versus a true investor. And if somebody's trying to buy this for 30 years, they maybe don't care about any prepayments because they're planning on holding it for, 5 years plus.
Right.
I like it. Credit score, we touched on a little bit. Obviously, the better you get, the, maybe lower or the higher LTV that you can get, but general brackets for a credit score, if you had to say, once you start getting below this number, there's really a concern, or can that just be kind of a big exception of what you can go down to?
Yeah. So it's going to be based. So I would say that non-QM or, private lending, ideally, obviously higher credit score is good, but, the 650 or higher, if once you start getting, below 650, 620, 580s, then it turns more into an asset-based loan, and that LTV is going to be pulled back way back. So in other words, like the ones I was talking about earlier that were 400 credit score, 500 credit score, whatever, those loans are going to be at 50% loan to value, So, I mean, you're not going to be able to make a loan at 60, 70% loan to value when someone has a 500 credit score.
So those two are basically inversely proportional to each other, basically meaning the higher your credit score, the less your down payment could be. The lower your credit score, the higher your down payment. Or you could say that they're directly proportional if you're talking about LTV, where the lower your credit score, the lower your LTV would be.
That's right.
When we look at debt to income ratio, I know on the QM space, we kind of generally, and I forgot to ask you this one, but in general, it's like, hey, can we keep everything less than maybe 45% as a rule of thumb?
It depends. I mean, like, FHA, you can go to 56%, VA, you go to 60%.
Sure.
But generally, yes. 45% is a good number. Yeah.
And then on the non-QM space, are we talking difference, or is you try to stay in that same range?
It depends. So yeah, non-QM specifically, they try to cap it at 50%, right? Debt ratio, and then if you go to asset-based lend, if once you flip over to like asset-based lending or cash flow type loans, the debt ratio calculation doesn't come into play. They look at the LTV spread, the equity spread. And so basically, if on those type of products, for example, like a rental property, if you're at 75, 80%, they're not even calculating the investor's income. They're just looking at the equity spread and does the property debt service off the rental income, the cash flow. So,
and is that based off of maybe hypothetical rental, or do you need some proven, data like a signed lease or something?
Right. Well, we get market. So when we order the appraisal, we get we have the appraiser do an addendum for the market rents in the area, and then he will determine what the rental factor is for the area.
Awesome. As we're talking through some of these, I know we're maybe getting kind of towards the end of it. There was a couple of things that maybe we wanted to touch on. I mean, you from you doing residential to investor to commercial. Anything else, Angelo, that you have your hands in these days that's top of mind?
Well, the other thing because we're a direct lender, and a lot of people, they reach out to us, they want to be a part of this on the investment side. So we securitize and, bundle our own notes as well. So, if you or any of your followers or, you're maybe not getting the returns that you want from Wall Street, and you want to invest in mortgage notes and buy mortgage notes, they basically pay out like an annuity, right? Like, let's say that, we have a deal right now, for example, that's for sale in Brooklyn, New York. I'm just reading top off my head that the property is worth $900,000. We made a loan for $450 and it pays 13%, and you own that note. You're the beneficiary on title. You're the mortgagee on the insurance policy. You're going to collect the payment on that is $4,500 a month. So you can't get that. With a 50% loan to value, 13% return. So if investors, yes, we package up and sell these notes to our clients. So that's a big thing that we focus on, is securitization.
And is that only for accredited investors? Can it be sophisticated investors? I know when you get into securitizations and if SEC gets involved, who would be a good fit for that? Can it be someone that's, maybe got 50K or 100K, or how does that work?
Yeah. Ideally it's an accredited investor, because only the tranches have to be, those are the ones that are regulated through the SEC. And for accredited investors, if it's an individual one-off note, we can still sell those to individual. It's going to be really hard to purchase one of these for $50,000 or $100,000 unless you do some type of pooling with other individuals, because the average mortgage in residential is $300,000, average commercial is like $1 million. It's going to be really difficult to do something with $50,000 or $100,000. But if you have, like, a lot of our investors, they have net worths of, 50, 100 million, a few hundred million, some of them have a few billion. And that works really well for them, where they want to buy, real estate in Hawaii, and they want to buy the notes, but they don't want to be a landlord, right? I don't want to talk to the person. I don't want to go clean up the house. I don't want to deal with any of that junk. I just want to collect yield, and I want to buy debt, and I want to have a large protective equity, and they have money to invest. It works well with family offices, trust, stuff like that, insurance companies where they want to purchase. But individual investors, we have some very wealthy individual investors too that they don't like how Wall Street and how that's going with everything, so they want to buy real estate debt.
Yeah, and for those individuals that have money just sitting in a savings account or a money market account that they try to maybe sell you as to get you 0.02% instead of 0.01%. Whereas someone, and even if you try to do like a 5-year CD, you're going to get nowhere near anything that you just rattled off. Cause I think a 5-year CD is probably at, maybe a couple percentages or something like that. Whereas this would be secured by an asset plus getting you a more modest return on the investment.
Yeah. I mean, think about this. I mean, I'll give you an example. Before I came on the show, we closed a deal for an investor in Plano, which is outside of Dallas, Texas, one of the hottest markets in the country. And it's a 13% return for him. Right. And so, I mean, the guy's sitting on 30 million in cash. The investor's like, I don't know where to put my money, Angelo. I'm like, hey man, buy this for 400,000. You're going to get 13% on it. And the person prepaid 12 months of mortgage payments and put 30% down. So, even if they default, I mean, it's a no brainer. I mean, so.
And I suppose even if they defaulted, although nobody would maybe want that situation, it could, how in theory, could they actually make more money than the 13% if they secured an asset and actually liquidated then the other 30% that they got down?
Well, right. That's the whole thing, right? I mean, you have so much equity you could, in a fire sale, still make money, And so, I mean, obviously we're not trying to have that happen, but I mean, sometimes that's why we had the client prepay 12 payments up front, because we don't want that to happen. But you have to obviously appease your customer and you have to appease your investor, and it's a dance between both of them. And so investors want high returns, and you also have to be able to take care of the customer and get them funded. So no, that's our last resort. But obviously, if the person doesn't make their payments and they're not willing to cooperate or work with you, then we have no choice but to foreclose. I mean, we don't want to do that. But I mean, in the event that if the customer, and that just on record, that's never happened to us.
That's awesome. Yeah. So you've been doing this for how long, and that's never happened?
20 years. Yeah. Yeah. So we've always tried to figure out a way how to work it out with the client, even if they lost their job or something happened. We're not in the business to collect people's houses. That's not what we do, but we are a business to make money. And so, we tried our best to work with people, figure out if they need credit repair. We use non-QM and private loans as a bridge to get them to better loans. Nobody needs to pay 10% or 12%. Sometimes it's necessary. And sometimes one of my wealthiest clients, he prefers hard money because it gets it done fast and quick. He can close a loan in 2 weeks where a bank takes 2 months, and he doesn't want to deal with the headache. But he'll move his loan to a bank later on to reposition. So it has a place in the market, but no one should be on a long-term high debt loan for the long term. At some point, we got to figure out how to fix the situation and get you to a good interest rate.
So as you're trying to appease customers, investors, employees, yourself, family, all of these different things, what do you feel like is Christian Financial or people that you're trying to serve? What's kind of the number one constraint right now? Is it scale? Is it customers? Is it education? Is it awareness? What do you feel like you're currently battling just from?
My biggest constraint, more awareness, more capital. If my thing right now is raising more money to do more of this. Yep. Because if we had investors and that's why, we're really pushing really hard to get people aware of the opportunity from the investment side, from the lending side. Because I think people are just not. I mean, how did you find me? But it's on YouTube or what?
Yeah, I was searching non-QM and ended up finding you on YouTube. We buy homes across the country and do something very similar to you, nowhere to the scale. And so as we were trying to educate ourselves, or if we can't help someone, we want to point them to someone else. And I never really had anyone to point them else because in the Midwest, or maybe just not in the area, if I mention the words non-QM, people would look at me like I had three heads. Like somebody would be like, what in the world is non-QM? And so I was like, okay, there's an opportunity here just for general education that if I'm trying to find this and I, Google what is, non-QM, and it says, here's the top 9, non-QM loan providers, and Angelo and Citadel and Angelochristian, comes up there, and I'm trying to search these, test them out, see who responds, who's putting out content. And so basically what I did is I kind of filtered out. I'm like, all right, here's the top 3 people that I think are worth starting to come on the podcast. And so yourself, Angelo, were some of those top 3. So I would say you're doing something well.
Yeah. Well, yeah. And so the reason why I brought that up is that I think that, and I appreciate that, and that means a lot to me, and I'm glad to be on your show. The the thing is that the constraint on is getting more people aware. I've gotten calls from and done loans for celebrities in Beverly Hills for non-QM, and they found me on YouTube or Instagram. And I'm like, that's amazing to me, because like how I met this person and I crossed paths with them. And, I've even done shows for magicians in Vegas, and, I'm like, wow, how did you find me? I found you on YouTube, man. My bank denied me. I'm trying to buy this mansion in Las Vegas or Beverly Hills. And so, but more awareness on that side, and then more awareness from the investor side to raise more capital, because what we're doing is really, really good. And we've helped a lot of people, hundreds of thousands of people, and helped a lot of investors get really rich. So that I would say that's our biggest constraint, is the awareness and more capital.
So what I would offer as feedback is what I think is one of your unique propositions. Number one, it appears that you've helped so many people, you've done it for this long, and you can do it nationwide. I know some service providers are like, okay, yeah, we can do it in Florida. We can do it in Texas, or this, this bank will keep it in-house and we can do it locally, for this one-off situation. The fact that someone listening could be like, okay, I know that they're in my area. Like I can feel confident in that, because I think a lot of people are like, oh, well, this, person's only, has their, is only registered in these 10 states. And I don't know if it's my state, so I'm not even going to try. And so the fact that you're doing it nationwide, I think gives you a phenomenal. So it was probably a pain in your butt getting licensed in all 50 states to go through that process, or I don't know how hard it was, but the fact that you can now say that you have national coverage, I imagine helps a lot as well.
Yeah, no, it does. It does. I mean, it really does. And we're proud. We're proud to be able to service that. And I hope by, us doing this video together, that more and more people are aware that we're here, to be able to help them.
Certainly. As we wrap up here, again, the whole intent of this show is to help create some more homeowners. Thank you for, sharing all of your wisdom. If people want to get a hold of you or find you, I have a couple links in the description, but maybe just for those listening in their car or driving or maybe don't have access to it, what's the best way to get a hold of you?
Yeah. So our company, again, we're real big about service. So, the biggest thing with us, we say call or text us. Okay. We actually talk to our customers like I talked to you. And I know that we're moving into an age of digitalization and hiding from the phone. And I don't believe in that. And so a lot of companies, they sit behind their email or whatever they do, or, they don't talk to their customers. And I'm seeing that a lot more. I don't like that. We actually talk to our client. We're actually open 7 days a week. So from 9 a.m. to 9 p.m. And and you can call or text us anytime. And so that's really our biggest thing. We obviously respond by email too. Our goal is to respond to all emails. And one of our requirements of the company is that it's mandatory that you respond to all your phone calls and emails every single day before you leave the office. And so, so we're
a high standard. That's great.
I've done that for 20 years, and that's what's helped me to keep the doors open. And so even after I'm done with you, I'm going to make sure that all my phone calls, emails, and texts are returned. It doesn't matter what time I go to sleep. What matters is that I get that done. And so we're really big about that. And so, you can call or text us at 832-431-6331. And like I said, we're open 9 to 9, 7 days a week. And then you can go on to our YouTube channel, which is Angelo Christian Mortgage, or Instagram is at official Angelo Christian. And you can check us out there. I mean, there's a ton of stuff on there. We have over 700 videos on our YouTube channel.
You got a lot of subscribers and followers on your content. It's a testament to probably the value and education that you bring to people. And I think I even saw that you personally or someone responds to a lot of the comments too, because I've seen, a lot of people, like you said, are maybe misinformed on everything. And so they think it's either the next subprime or whatnot. And so I thought that was really admirable. Some people just put up videos and kind of don't follow it. And so you guys were actually trying to clarify, maybe some misconceptions, through comments and other feedback as well, which I thought was really good.
Yeah. I mean, I try to, I have you mentioned Jeff earlier. He's one of our all-stars here and our marketing manager. I mean, he helps me with it. I do try to respond to, as much as I can. But there's literally thousands of comments that come through there. And if there was more hours in the day, I could probably figure out how to get to the rest of them, but he helps me a lot. with the response. But I do personally, yes, that's me and him doing that together. And then we have some other people that help too. But yeah.
Wonderful. Well, thanks for sharing all of your knowledge. If you want to get in touch, Angelo just shared, maybe 5 different ways. Sounds like Instagram and YouTube. He's got some great content. I know I was personally following him now as he's putting out some of this information. Thanks again for your time and hope everyone has a good day.
Yeah. Thank you, Adam. I really appreciate being on your show.
You're welcome.